This is the first of a series of Fireside Conversations we're going to be doing over the next few months. This conversation is with my friend and business partner, Sune Sorensen. Sune is an economic advisor. He's also a senior relationship manager and advisor to our clients. And he's a really interesting guy. Sune has lived all over the world and is going to tell us a bit about that. He's also going to tell us why he ultimately, at this point, chose Switzerland. We hope he stays. We're also going to be talking a bit about the big picture dynamics, geopolitics, and financial markets. And there obviously also a bit about debt, inflation, and most importantly, how to protect your wealth in this time. Sune makes a very important point there that wealth protection is not just about investing, it's also about structural planning and making sure that you get your custody right. With that said, I look forward to this conversation. It was filmed right before Christmas. So to everyone watching, Merry Christmas and a Happy New Year. So Sune, wonderful to have you here in Edmatingen for the first time, and that you found your way from Neuchâtel up here into the boondocks of Zurich. So thank you for that, and thanks for coming.
Impressive journey. We sprinkled snow for me. It's been it's a beautiful journey here, and gave me plenty of time to contemplate.
Excellent. So I think let's go right into the middle of it. Something I'd really like to touch on is a bit of your background, because you grew up in Denmark, but then you became pretty much a bit of a very rounded and very well-informed globetrotter. Living in all kinds of places in this world, and it's been quite a journey. And let us know a bit more.
Not a plan, I'll reveal straight up. We kind of left for 1 year and never really came back, and just started enjoying, experiencing different places. Not just, obviously holidays are nice, but living and working and building businesses and raising children eventually in different parts of the world. I think it's the best form of education you can have. It takes you outside your comfort zone. I think it teaches you a lot about how different things are around the world, but also the commonalities between people. We are essentially after the same things for our families and kind of within communities. And I think that's a great lesson. And I think you learn a lot from the travel experience. I think one of the things you learn is how little you know, which can be a good starting point, and certainly is probably something I also see in the work we do. So macro investing, I think the more you dig in, the more you read about any subject matter, the more you realize you don't know. And again, that then either gets you to shut down and run away from it, or you kind of lean into that and try and figure it out. But it also gives you a level of humility, which is important in investing. So you start thinking a little bit about margin of error. What if I'm not right? Or maybe there's a different way to look at this.
One of the most humbling experiences, I think, is in fact if you go from, out of that comfort zone of your culture and into a different culture, and you've done that several times, kind of merging in and living in different cultures and places. And what was the first stop after Denmark?
I had 10 years in London, so I continued with rainy weather, but a slightly bigger city. Very metropolitan city, again, obviously great historical place. And from there, I kind of transitioned to warmer weather, so we ended up in Spain, in Barcelona. Nice. Again, another great historic place. And we had some time in Cape Town, and then we ended up in the Caribbean.
What were the reasons of moving on to those places? Was that mainly business?
Definitely not business. So I've done very little business in any of these particular places. So mainly more the experience, and a lot of it was kind of opportunistic, and again, more lifestyle decisions than business driven. Martinique's obviously, I worked with some iteration of BFI for more or less since I think 2008 when I first ran into Daniel. Right. So Switzerland has kind of been a cornerstone of it while I haven't lived there. This has kind of been my framework of thinking around investing and building that business out. Right. And then our audience or clients have been US. So most of my world essentially revolves around those two pieces, while my day-to-day then has been in these different places. So that's also kind of an interesting, in some ways you're somewhat removed, which I think can be useful in investing. It's a little bit the Swiss model. It's sitting and looking out at the world and trying to understand larger trends. Mm-hmm. In some ways, people often think, you should be on Wall Street, or you should be in the middle of the city of London or something like this. And I think in that place you end up a little bit with a way of kind of thinking like the crowd and with the herd, and you can be dragged into this kind of this energy or this dynamic there. Whereas I think when you're sort of an outsider sitting looking in, I think there's some value in that, both in terms of just trying to learn about the world, but specific to investing.
You ended up in Switzerland, and you recently you mentioned a few things of Switzerland, and I realized you're actually quite a fan. And
For sure.
obviously, I'm Swiss, so I love Swiss fans. But so, what's in your view? Ending up in Switzerland, sending your kids to school here. Why was that a decision? What do you like about Switzerland that you see is different from those other places?
Some of the things that stood out to me early on was if you just look at Switzerland from the outside, kind of just the numbers, it doesn't really quite make sense that this should be a well-functioning society, because you have this tiny little speck of land in the middle of Europe with all of these bigger powers surrounding it.
No natural resources.
No commodities, mountains. I mean, up till a couple of 100 years ago, most of it was not connected. So you had all these valleys, all of them not really. No ability to scale, not a large population. So it's one of these larger lessons of history, I think, is that the big lift, the real innovation, the real achievement comes against the grain. It's against the constraints that we are at our best eventually. And I think there's a lesson in that. And I think Switzerland is kind of like it's become a tiny global giant, I like to say, in the sense that it touches all of the key industries at a very high level, yet it is just this tiny little place. And you can go into the demographics. I mean, you literally got 4 different languages, 3 of them of surrounding powers. And I think something like 30% of the population is not born in Switzerland. Yet you got this very integrated society where there is a distinct feel of being Swiss and kind of people kind of gathering around that idea. Whereas in other parts of the world where you have these same dynamics demographically, that has not been the case, for example.
Yeah, that's true. It's if you look at a big part, especially of the Western world, I think you're seeing more and more demographical changes. Not just the aging part, but also the fact that you have much more ethnic diversity. You have a bit of a growing wealth gap. And those are things which actually, if you look at the history of Switzerland, something I think most people don't understand about Switzerland is Switzerland, when it was founded and when we created, when we also wrote our constitution back in 1849, Switzerland is a very diverse country, not just in terms of religions, or I should say confessions. There was historically was quite a bit of strife between Catholics and,
Sure.
and Protestants in Switzerland. But it's like you said, we had from the very outset we had different languages, 4 different languages. We had huge wealth gaps. There were very poor parts of Switzerland where it was very hard to make a living. During those times, actually, quite a big part of our people made a living by being farmers and mercenaries.
Yep.
So that's an interesting part of Swiss history, and we should probably get into that in some other fireside conversation. But ultimately, I think it's really what you said about constraints or the limitations of Switzerland, forcing us to kind of, with this small speck of land, then becoming international traders and so on, how that evolved is part of the story. It's also the strong currency actually helped us become strong importers, become very strong in innovation.
Yep.
There, you just sent a statistic on innovation. I think we're like the #1, even in front of the US in terms of
Sure.
innovation. And those are things most people don't realize about Switzerland. So that's well caught by you.
I think it's, if you could build a portfolio that was Switzerland, so there's a permanence to this place, which is kind of the infrastructure, the maintenance, the education is not something you do overnight. It's something you have to build processes and systems around, and it serves the country, and then that reinforces the commitment to continuing these things.
Yeah.
So that's kind of in the foundational piece of a portfolio for me is kind of the permanence, called it real assets.
Yeah.
And then I think the other side of the coin is this innovation, this lifting against the grain. Because if I'm looking at companies, if I'm looking at industries, I'm looking for that. And I think what Switzerland has done is being able to look at this, educate their population towards harnessing these opportunities, and then really leaning into those industries where you can have this real kind of profit leap from adding skills that it can't be done overnight. So you're not out competing anyone on scale manufacturing, but on the kind of precision manufacturing. That's where the opportunity lies when you don't have a huge population, for example. And again, you can go across every industry that Switzerland is dominant in, and all of those, you can tick those boxes.
Yeah, even during this period when, in terms of trade balance, what we see is that Switzerland is holding up much better than the
Sure.
rest of, if you talk about the EU, the Eurozone, this little country is actually holding up and still has a positive trade balance, which is
Yeah.
unique these days. I think ultimately I agree with you. I think it's dependent. It comes from the system that we've built over time, and actually that constitution that we started with in in the 1800s, which is built on direct democracy, a federalistic approach, giving quite a bit of also fiscal power to the cantons, so the states of Switzerland, but even the counties.
Yeah.
And that I think is unique, and it just allows the Swiss to take part and help build and improve and solve problems. And I hope that we can continue maintaining that system, because there is, even in Switzerland, a bit of a tendency towards more federal type decision making and policy. And I think a bit similar to the US, where you always have that tension between giving things out to the state and doing things at federal level. I think in general, people, that's that eternal fight of how much centralism, how much state, and how much power to the people.
I think at the core that friction is healthy, because you need both, and they need to balance each other to some degree. I think where Switzerland works for me is the direct democracy, the idea that you can be a stakeholder in something and that you see it working for you. I think that's maybe the contrast I see when I travel to many other places, the US included, but also around Europe, for example, is that if the population have a foundational belief that this system's actually, it's not all great every day, and you will have your frustrations trying to do something, but largely you feel like you're part of something where the larger is better than the individual setup, and you still have the freedom to be an individual. I think that's a very powerful dynamic. When you have that, I think you have something that is anti-fragile in a time where there is a lot of volatility around, whereas I see in many other places, maybe there's a little bit of a loss of this belief that this larger system is better for them individually, and then that starts nagging away at it, and over time that can be a problem, because there is you give something up to be part of something larger, and you have to give it up because you feel that larger is something that it gives you positive outcomes for you and your family over time.
I wonder what you think. I mean, I'm a fan of the Swiss system, and sometimes I think it would be nice to export that system to other countries, but very often you then get the answer, oh, that's not possible. It's only possible in Switzerland because you guys are so small. And I don't know. I don't think it's true, but I'm not sure. What are your thoughts on that?
Well, I think that, actually I think we are heading somewhat in that direction. I just think we are like at a friction point between decentralized and that belief system. Maybe some of the nation states that was constructed doesn't quite make sense in the modern context. I think people live regional, local lives. I think I see it in my children, where they have a very attached to whatever that life is. They're social, they're involved in society at a local level, but then their life, because of the communications, is global. And then that leaves that friction point where you see sometimes, I think, certainly within Europe, there is nation states where they're kind of grasping on for control, but really the population is drifting to a younger demographic that doesn't really see the world through that lens. And I think over time, if you think about that, it's a little bit the Swiss model is kind of a global, larger idea that we are in a larger context, but also being protective around what works locally for each individual and the community around that. Right. So I think there's a natural transition there. I don't think it'll be out friction, and I think we're seeing some of that at social levels across the world right now.
Interesting. Yeah, I'm not sure about the trend. I mean, I hope you're right, because the trend I see is right now I see a lot that is going the other direction. And one thing that in the big picture of things, there was one chart that you sent, that graph that picture of how the world I think that picture was like over the past 20 years has gone from blue to red, in a sense that in looking at the trade balance or the biggest trade partners, what you saw over those 20 years is that 20 years back, most trade partners or most of the trade was done with the US. Yeah. And that map really shows powerfully, everything's blue, and then there's China. Yeah. And now 20 years later, it's actually turned around. The other way around. And it's quite interesting. What do you make of that?
I think it's a longer trend. So I think we've had a special moment in history the last, let's call it 70 years, since the end of the Second World War, when the US came into true primacy, which has served the world incredibly well. I mean, if you look at global GDP from that period, it's like a hockey stick. I mean, we've gone from, I think it's $3.5 trillion to whatever, $80 trillion, and obviously some inflation in those numbers. But on an economic sense and on a global scale, the last 70 years has been great broadly for humanity, and it has been under the Washington Consensus, and it has been under this kind of the US in that primacy role. I think we had a unipolar moment, which again, if you study history a little bit, is a very rare thing, and I think we started maybe in the last 2.5 decades to gradually drift to this other thing, and
to more of a multipolar
situation, and again that then leads to different systems kind of up against each other, and that again have some volatility normally around it, but I think largely it's a very common thing to see throughout history. And I think the lessons are not that the world is ending or that China is now taking over. I just think we're going back to something that is more multipolar in nature. And if you're building a business or an investment portfolio around what was 25 years ago, then you're probably going to end up in the wrong place because the map doesn't quite fit the territory anymore. And I think that's maybe one of the larger takeaways from this.
I like how you say a bit of turbulence or volatility, because in my view, if you look at history, I think if you see a global power, thinking back to the Romans, for example, as you come to the end of that period, and I'm not even sure we're coming to the end, it could be a long process and it might actually balance out in a more multipolar approach, but the concern is that during those periods you do get quite a bit of volatility, a bit more volatility than we might want.
Yeah, I think it depends a little bit on the how fast, that's the question. If you look at like Great Britain, for example, as we started out with my time in London, well, I know you've just been in London, so you walked around those streets and you can see this used to be a capital of global power, and now it is this tiny, relatively small speck of land with very little global interference outside of the city of London, perhaps in the financial sense. But that's been a gradual process to a US dominance, and obviously there was some overlap in interest between those two powers. So you did see more of a transition. For me, the US will continue to be a very powerful piece. It has great geographies. It has control of that domain of the globe. It has incredible businesses. It has a vibrant culture. It has an ability to take risk and innovate that hasn't been rivaled at a scale historically before. So I don't think it's going away. I think it has some questions about what is direction, and on a relative basis, the power globally will probably be better served closer to home, which I think they have some issues around what they're trying to find a new direction after this kind of 70-year run. I'm pretty sure it will come out of it pretty well. I'm not sure the next couple of decades is going to be great on all fronts. But I think Europe is somewhat in the same position because they've been under this US umbrella and is trying to chart its own path and figuring out internally what that looks like. And I think, to be honest, China is not this kind of dominant rising power with no issues. It has plenty of issues again domestically. So I actually think the next decade, certainly, Europe will be busy with Europe, the US will be busy with the US, and China will probably be busy with itself, and everyone in between is trying to figure out how to be part of these different larger groups of the global economy and the kind of security framework that I think is starting to materialize. And I think, for example, what we're seeing with Russia right now and the Ukraine situation is a vacuum. It is kind of it's sort of a lasting.
What do you mean it's a vacuum?
It's the sense that, 30 years ago, the US was so dominant that even we had the Cold War. I mean, we were just talking about it before this coming in our upbringings, the Cold War and the Soviet Union, and the kind of, that map was like blue and red, but literally in the security sphere, right down through the middle of Europe.
Yeah. You and I, we grew up during the time when we had to go underneath our school benches and run into the bunker. In Switzerland, we have bunkers everywhere. Yeah. Do you have that in Denmark as well?
In Denmark, we just had newspapers on the windows and underneath the desk type security measures.
So in Switzerland, we had every house has a bunker. I still to this day, when you build a home in Switzerland, you actually have to. Now not everyone has to have a. It's not a bunker. It's a shelter, I guess. But it's really like thick.
Yeah, I've seen it in
walls, and the store that you kind of shut. So I have that in our house, and we grew up during a time when I went to school in primary school. I still remember we had these exercises, these maneuvers where the teacher would be there with the stopwatch, and you had to run into the shelter. And it was a very different time. And to some degree, I hope we're not heading back into that time, because I agree with you that there's a bit of a recalibration of the world, and I think there is some interest in the West, and I think that there are some arguments to say that in that kind of Cold War scenario, there's also benefits, in a sense that there's clear lines, and we just hope that the war stays cold and doesn't get hot. It's right now what you see in all the policies from the U.S. but also internationally, I think, is that due to Corona, due to the Ukraine war and the resource problems, there is that recalibration, and you're trying to move towards more self-sufficiency, and that has all kinds of implications politically, economically, inflation-wise, and so on.
Yeah, I don't think we're going to have clear lines. It's probably not I think we're ending up in a very grey world, which I think historically is what we've seen. The borders change. We talked about that as well over time, much more frequently than people kind of think. We tend to think in our own life cycle. Yeah. Whereas if you think a little bit further, certainly Europe, you will have seen that it's a constant changing and evolving space. I think we come from an investment background, so it's really about you quickly understand that no one knows the future because the market will tell you that regularly. There's supposedly certainty in hindsight, but again, even that, we talked about how history is interpreted by different people in different ways. So you're ending up with probabilities, and I think for me the probabilities are not that we're ending up in a new Cold War with China and the US kind of butting head in the traditional sense that people associate with Soviet Union and the US. I think there'll be competition, but I think, back to my point, I think there's constraints on all of these parties, and it might be actually a pretty good balancing period once we get through a little bit of this period. And a lot of it is still, based on what the US decides to do and how it decides to transition. And again, I think they are still the drivers of most of these activities we're going to see the decade out, and it's whether they make good decisions around them and how Europe responds, how China responds to some of this.
One of the things I really love, and we've discussed that, was the those animated pictures and how history changes. And you told me you actually show those animated charts to your kids, and I think that's very helpful because a lot of the tensions or the discussions that we have these days are kind of stuck in time and geography. It's like if certain topics are discussed in the here and now, if you look at even the topic of feminism, for example, it's everything's so bad, and yet if you go back a few hundred years, you actually realize we've come a far way.
Sure.
If you go outside of the Western Hemisphere to some other countries, you go, hey, we're actually not too bad off. So, and these animated pictures of how history evolves, and combining that with statistics and charts, I think it's valuable. One of the things that right now, obviously creates quite a bit of a issue or challenge for the world is the fact that for many years we had lower and lower interest rates, lower and lower, actually very low deflationary periods, and that has changed. We are in a bit of a paradigm shift to some degree, and a lot of that paradigm shift, which geopolitically, economically, has all kinds of elements to it, demography, etc., technology, innovation. A big part of that is really that change of the credit cycle, the big credit cycle, where now we're headed into higher inflation and rising interest rates.
Definitely been a change. I mean, again, I think there's an interesting 2.5 decade period backwards, and I think we talked a little bit about it in the context of the US, and we can talk about it in the context of technology, and there's a context within monetary policy and within kind of the financial system and the credit cycle. Right. I think when we talk about moving from one era to another, which we've done a lot of work on internally in the last couple of years, I think. So, let's start with the financial and then maybe go into some of the economic aspects to it, and then maybe the technology side. So on the financial side, I think there has been a period where, because of some of the central banking and generally the credit cycle and some of the stuff that has been going on underneath that surface, we've had a period of time where you could kind of do the ordinary and get extraordinary outcomes, either both as an entrepreneur perhaps or as an investor certainly, where you could essentially do pretty bland stuff, buy an index, US market index, and get close to double-digit returns year after year.
Right.
Yeah. And historically, that is not the reality. The reality has been that to get extraordinary outcomes, you had to do extraordinary things as an investor, as an entrepreneur. And I think that cycle was somewhat flawed in the sense a lot of it was credit-driven, meaning there was a lot of malinvestment. There was a lot of great achievements across innovation and across some of the stuff that was financed was important. But I think we're coming to a stage where we're kind of pulling back the blanket a little bit and saying maybe there is a lot of malinvestment that has only really been fed by a credit cycle that was unusual. And I think that will become, as an investor, something that you need to look out for. And I think, again, if you're kind of pinning your hopes on being able to continue to do the ordinary and get extraordinary outcomes in terms of returns, I think you might be in for a rude awakening as we head into what I believe a time where we come back to the historical normal of having to do extraordinary things to get extraordinary outcomes.
I think, I mean, even breaking it down just to the very lowest level is we're talking about the cost or the price of money.
Yeah.
Which has been zero or negative, where you get paid for. So negative interest rates, has been an issue, and it has created imbalances. And just thinking back to Econ 101 or Macro 101, interest rates have a role in pricing projects, in making decisions. And if that interest rate is zero, what are you basing your decisions on? And that creates all kinds of, if that you don't have that lever, that price of money, you're lacking reality. And so reality is returning. And one of the things I actually like to see in the current phase is the fact that also we're having a lot less talk about things like modern monetary theory, right? Where basically that theory says debt doesn't matter. Debt can be eternal. And I think we're now getting a bit of a reality check, which is healthy in my view.
Yeah, the question is, do we get to play it out to what we would call capitalism, which essentially is there will be bankruptcies and there will be, destruction of debt, which is still maybe something we can dive into. To just the point on the interest rate and the cheap money, I think we talked about constraints and how that can actually be a driver of innovation.
Can be very beneficial and healthy.
Exactly. If you have no constraint on the monetary input, that means that the constraint becomes on the quality project, the quality of the individual, the quality of ideas. But if you have this kind of fossil of constant credit being pumped into it without any kind of trying to find a place, you're ending up financing things that doesn't have the merit. Right. The idea, the individual, the company. Right. And again, back to the capitalist model, that means that you're essentially building things and maintaining those things for periods of time where it doesn't make any sense for them to be operational. And I think that, again, is an underlying issue that I see certainly across the Western economies a lot, and within pockets of China, for example. So there's a credit risk aspect to it. I think the interesting leap out of that going forward is how do we deal with this? Because if you look at like 2008, which was really the first time you talk about extraordinary measures. In truth, the extraordinary measures really came out of the bag after 2008 when we kind of bailed out the financial system in the US and then in Europe into the hundreds of billions of dollars. And at the time, people were losing their minds over these numbers. I think the largest bailout in history outside of wartime was essentially then. Then we kind of went through a period of time where we flattened out a bit, and then we had the corona crisis, and then literally we're bailing out into the trillions of dollars, and that is still in the system. So we have never.
And in that period, just to what really happened there was, in addition to monetary, we had fiscal policies, which were rolled out in big style, and that element of inflation that we're seeing right now also has to do with that to some degree.
I think that definitely is that's going to be much more pronounced, I think, later into this decade. I think the fiscal and the monetary, I think, is really a key point to understand here. We are in a place where, in most part of the world, it is an accepted fact that fiscal and monetary policy essentially are one, even if they are somewhat separate institutions within the US and within Europe, certainly. But
the separation of power of central banks is, you question that?
I question the idea that if we're going to keep rolling the debt at the government level and pay off a slightly rising interest rate on top of that, and we are then also having larger issues, structural issues that we haven't dealt with, some of them positive in the sense that we're rebuilding infrastructure, we're doing some of those things, but also just the pure constant of keeping the music playing, basically. If you're going to keep rolling that debt, and we're going to add more on top of it, then you're going to have an issue that is not really solvable. And if the answer is always being addressed through fiscal, that then has to be financed somehow, and the central bank is essentially with a mandate to maintain stability and maintain operation of this social system and the economic system, it's very hard for any central bank to stand up and say, look, we're not actually going to buy this debt if there's no other buyers of it. So then you're ending up almost in quantitative easing on automation. And I think that's why I'm thinking when we get beyond 2024, for example, US elections, I think it will be important to see what comes out of those at that stage. But I think really at that stage, you're going to have the monetary-based deflation because we are starting to have such a huge role constantly.
Well, let's break that down a bit, Sune, because I think that's, if we look forward, that's definitely one of the topics that is being discussed a lot, is the question of, is inflation going to go higher? Is it going to stick around? May we even have more deflationary powers? And combined with that question, then obviously we also have the question of higher interest rates. Will will the Fed continue to raise interest rates? What's happening in China and Europe, etc. Let's ask the question maybe, what are the things that speak for higher inflation as we move forward, which then can draw also higher interest rates?
Yeah, so actually I think that's an interest. So again, inflation means many things to many people, and the way you look at the media today, it can be confusing. So I think the inflation I'm talking about in this longer term horizon is the real kind of historic inflation, which is the debasement of the currency, the mixing of fiscal and monetary policy, and it becomes much more of a sticky, constant, almost built into the monetary system. The inflation I think we've seen in the last year has been, number one, out of Corona, basically switching off everything and then trying to switch it back on again, led to some situations around key inputs to the economy at the consumer level, at the industrial levels. And I think largely that has been dealt with to some degree. Then we've had kind of the Ukraine-Russia thing, which then became more of a specific commodity play, where we had certain things like the energy-related commodities, some of the base metals, etc. The prices rose significantly. And that then fed into the system. And then all around all of this was kind of a realization, to your point, for the first time in a long time, people started talking about inflation in developed market in double digits, and people started thinking. And inflation in some way is a psychological thing where the consumer wants to buy today because they think the money is going to be worth less tomorrow. And we had a little bit of that. I think a lot of that was based around those kind of, I thought, somewhat short-term factors like the coming out of the COVID and the coming out of the situation with Russia and Ukraine. So I think in that those types of inputs, I think we're moving away from. So to the point, I think next year we could likely see deflationary aspects coming from the fact that these two things phase out.
I won't let you off the hook that easily.
I didn't think you would.
So I just want to challenge you a little bit on what you said. I agree 100% there. With Corona, I think there was also that realization that self-sufficiency is becoming more important. We talked about that a moment ago, with the recalibration also of supply chains. And I question, whether changing supply chains and restructuring things in a way that allows for more self-sufficiency. Is that such a simple and short matter? I think it might take longer. What you see is these kinds of systems, be it the transportation processes and ways, the contracts between the different parties, etc. All those changing those things takes time, and it creates a time of turbulence, in a sense that these systems have kind of grown over the past 80 years, since the Second World War. And we're now in a process of changing those. One of the best examples is chips. A lot of the things that have happened, and you sent some information on the whole semiconductor industry and how that is changing, and we can touch on that a bit. That change, those changes have huge geopolitical, economic, and business adjustments that come with it. And I think that will keep driving inflation more. I agree. There's also deflationary. We'll get to that. I won't.
Okay. So let me. So on that one, so that's slightly different than the COVID coming out of shutting down and starting up. Because again, there's kind of like we're starting up, and then there's some questions raised around what were we doing before, and does it make sense considering what we just learned out of COVID? Can we bring things closer to home? Can we be less fragile? And there was an awakening around maybe some realities. There was kind of inconvenient truths that the system we built was built for optimization of outcomes for the consumer, low price.
It was an awesome system. So I mean, if you sum it up, you had that Russia was providing resources.
Yeah.
You had the U.S. consuming, or the West consuming, and you had China producing. Kind of. That's a bit simplified, right?
Sure.
But that was kind of the system, and we're now changing that.
Yeah, so the question becomes, so there's definitely a political will, specifically in the US right now. It's very popular to be talking about this. There seems to be support for at least the idea of dealing with some of these issues within the US, which I think is healthy. It's part of that larger process about strategically positioning itself for the future. My question, and we talk about this quite regularly because from an investment perspective, these are actually quite interesting and important questions, is will this move beyond the rhetorical? Will this move beyond government stimulus, initial kind of push? Mm-hmm. Will it become the actual reality? Mm-hmm. Not just in the next 6 months. We'll probably have some CapEx spend because there's a drive towards that. But will it stick? Because to your point, the system we had before was great. It gave deflationary across goods and services, generally speaking, technology-based stuff at an incredible level, which we can go into. And yet it did spread wealth around the world. Within societies, there was inequality coming out of this, and that's maybe some of the political drive is more around that
especially
question.
in the West, you had,
Exactly.
also with the monetary policies, the wealth gap has grown. However, if you look at a global scale, I agree with you, the world has benefited hugely from that overall global free market, at least in most areas, right? There's obviously always downsides.
There's always exceptions. Right. But so the question becomes, when we really look into this and we start facing the actual choices around this, because to your point, if we do break up the system, then we should also expect that deflationary forces to be washed out of the system at a time where we just talked about the monetary inflation becoming more of a sticky and gradual thing coming into the decade. Will there be political will and a level at the median voters' decision making where they will accept higher cost of living, driven both by the fact that their currency is depreciating and the fact that goods and services are getting more and more expensive because we want to do this thing, which is breaking up what was essentially a very efficient supply chains across most of what we do, what constitutes the global economy. That's obviously into the future, so who knows? But again, it's very rare that a population will vote against its own interest continuously over time, even if there is kind of a political driven rhetoric around some necessary change, but also kind of trying to use maybe foreign enemies as kind of a way to exert control over processes more domestically. It remains to be seen whether that actually allows to happen.
So we agree there are some inflationary factors. And now the talk obviously goes around what sometimes is referred to as U-turn from the U-turn. So basically the question is, and that's what you're, I think, getting towards, is the fact that you think that ultimately the Fed, central banks in Europe, will turn and actually start, more quantitative easing again, whereas currently we're going towards quantitative tightening. And how it will balance out, we don't know. I think we agree that central banks and governments are kind of between a rock and a hard spot.
For sure.
So let's talk about some of the deflationary elements. Where do you think, what will help governments actually, lower interest rates without inflation going through the roof?
Well, so if the premise is that the inflation we've seen more recently, which got, certainly the Fed to become very aggressive with interest rates, certainly nothing we'd seen in recent times. In reality, there's still real negative rates. So,
True.
While people are talking about this very, hawkish Fed, historically not really true when you look at the numbers. But
liquidity has been...
Sure, they drained it out, but then it's where do you start? So in relative terms, we
Right.
just had the largest fiscal and monetary event out, since the Second World War, basically, in terms of compared to GDP numbers.
Absolutely.
So any kind of scaling that back a little bit, I don't know if that qualifies as hawkish in my kind of historic context, but so the question is, did they kind of overreact to an inflation that wasn't really the real inflation? The real enemy of them, what you want to try and do with interest rates would be what we're talking about further down the line, is constantly rolling this debt and adding to it, and the kind of sticky monetary inflation, which I think is not actually what has been driving the inflation we've seen so much yet. So did they react to kind of the constraints on supply chain? Did they react to the Russia-Ukraine, thinking that they're now seeing this enemy that they've been waiting for? And maybe they overdid it a little bit in the cycle, because what I think, to your point about deflation, I think the risk is that most recessions and most crises have generally started in modern times, when we have this monetary experiment that we've been running for a while now. It's essentially them who either overdo it on one side or the other, and we have either the credit cycle go out of whack to the upside or to the downside. Right. And I think the risk now is if the Fed continued on its stated policy, they may actually just force the US into recession. And I think then you're ending up in a place where we're then going back into that cycle certainly in the short term, where it would then be fallen upon these wonderful institutions that we have to try and kickstart the economy again, and we would have some other issue, some kind of crisis, something that had to be bailed out, and we would be back to that full fiscal monetary merge, driving up this wonderful bowl that we are pushing in front of us, which is this cumulative debt that we are constantly rolling over and adding a little bit of interest and a little bit more interest to it now. So it'll be interesting to see if they stick on that.
So the negative, or the bogeyman is insolvency ultimately.
Sure.
The question is, where could those insolvencies hit? Could we have another credit crisis in Europe, in the US, China?
Yeah.
you also, the other problem is obviously you want to keep economic growth going. The prospect of recession, which seems quite realistic. I think other parts of the world were already there. Relatively speaking, the US is doing much better.
Sure.
So as far as the policies that the government can do, you're talking about this median voter,
Yeah.
ultimately, which could force governments and central banks, because you're saying they're not really separate, into loosening or more monetary easing. That's your expectation. So you expect that to happen?
Yeah, I think certainly in the West, where you have democracy, they tend to vote for. Whoever gets elected, they will call it different things. But what we've seen, certainly the last couple of decades, is kind of more stuff, less taxes, kind of thing. And that's left and right, to be honest. And right. It's either we're rebuilding the heartland, or we're greening the economy, or whatever you want to call it. It's the same thing. It's fiscal and monetary, basically mixed into something and then directed into certain pockets of the economy.
One other thing that you recently brought up, which I thought was really interesting, is the fact that we talk about a lot of different asset classes.
Sure.
The big blockbuster right now is crypto, right?
Oh,
which
yeah.
is like a little sliver of assets. But actually the big elephant in the room is real estate.
Sure. I think the illustration, I think we'll probably share it. I think there's around I'm not exactly how sure they got to the number, but there's $258 trillion, I think, of real estate value.
Residential real estate.
Yeah. And so the thing about real estate, that's obviously interesting in its own right. Number one, I think crypto is whatever, 800 billion, whatever, depending on where we are today on Bitcoin. But yet all the news is about this issue. But the thing that's interesting to me about the real estate, and why I shared it initially, is the idea that all of this real estate generally have credit attached to it, because most people own, the largest asset most families have is their home.
Yeah.
And corporations have commercial real estate. So we have, most of this stuff is leveraged to some degree. So this feeds back into the median voter. It also feeds into corporate, which we can talk about. But number one, if you own a property but you're largely leveraged, you're very sensitive to interest rate. Mm-hmm. So if the median voter, outside of the inflation stuff that we just talked about and the kind of level of interest around that, long term it's not really in the interest, because most people are debtors. Most stakeholders in societies are essentially in debt, and therefore interest is not their friend. So they're almost aligned with, let's say, the government, who is largely in debt. Raising interest is not in their interest. So let's say within a developed world country, let's say Europe, US, you kind of got three constituencies, and one is the consumer, the person, the individual. Then you got the corporate side, and then you got government. Yeah. If you look at that, and you look at all of these three blocks, specifically in the US, have huge amount of debt attached to them. At the corporate level, for sure. Individuals, for sure, across consumer, across obviously property. And then at the government level, you have incredible amount of debt. I mean, you've been running, not a balanced budget, let's say, kindly, for a long, long time. So all these constituencies essentially aligned in the interest that interest rates should be low. We should slowly probably debase our currency, because we are debtors and we are paying back in this thing. And as long as we can keep kind of out earning and paying it back, that essentially is the only non-destructive way out of this. And obviously history is full of examples that goes in a gradient from hyperinflation, complete destruction of societies, to something that is much more mellow. And we have done this over time. We have managed to earn our way out of it by essentially debasing the currency over time. So it's probably the softer choice. And then when you look at the free constituency...
So basically what you're saying is, how can we get rid of this debt without destroying the candy bar, or the how do you say, the candy jar, I guess?
Candy jar, oh yeah, that's a good say. There's definitely a lot of sugar highs in there right now, so it's probably a good analogy. Yeah, the question is, no one wants the current system to completely be destroyed.
And you're saying that actually the preferred measure, and that's something that Reinhard and Rogoff, they wrote about a lot, is going to be inflation, both for governments, but also for the voter. And what you're saying is that with real estate being such a huge asset class, it's going to play a role in how the constituents, how the voters would actually want things to go. So slowly but surely maybe having a moderate inflation, which then kind of does away with that. You on the other side, you have pensions and savers and et cetera, which don't like it. And,
yeah, but I think we even in some, so that's an interesting, so my approach to this is not, my approach to this is trying to figure out probabilities of outcomes as an investor. Yeah, so all of this is from an investment perspective, not my belief in how an economy should run. Let's make that very clear. But the outcome for investors is, I think the probability is higher that we have higher than average inflation for a prolonged period, and it becomes the sticky kind one that comes from debasement of currency in the West, certainly. And the probabilities is actually that they can probably get away with it, because if you're the US, you have a unique situation where you can, as long as you don't boil the frog too quickly, it'll probably remain in there because it's too scary outside the pot. Yeah, and that's kind of the game that you're playing, the game of chicken, just to mix analogies up here, is do you want to remain within this nice warm bath, or do you want to be out in the cold tomorrow, or do you realize that maybe gradually it's not going to be great for you? And that's kind of the game.
Even if it would be the right thing to do.
You know, it would be, but then, you know, there's some of these things where it's like,
it's cold out there.
It's cold outside, yeah. So I think that's the larger point I would make around this idea of the inflation and the interest rate, is that I think as an investor, you should be preparing for higher inflation over time, which means if you, to your point being, so you mentioned then the savers of society, yeah, which supposedly is our pension funds, but most of them now allocating into highly leveraged asset classes, so they actually have an interest in money, in asset inflation, yeah, so that's almost, they're also bought in. Right. So there's that. Yeah, obviously for the savers, as someone who's built, let's say, generational wealth, which is our classic client, you definitely want to factor in that as a risk factor, that over time, one of the ways to have permanent loss within your portfolio, we're back to inflation. You know, it used to be if you're an emerging market family, you're definitely aware of this, but I think in the developed world, a lot of people,
we've forgotten.
They only remember it in 2008 when everyone, you know, ran to gold and thought the world was ending, you know, and then they realized, and then they're right back onto the same kind of game after that. I think if you're thinking 20, 30 years out and a wealth transition, you need to think about inflation as something that will lead to permanent loss of your, not just your purchasing power and your currency, but your actual wealth if you're not positioned to harness it the right way.
So let's think a bit about how to invest, you know, maybe let's not do 20, 30 years, that's awfully long, but let's think about maybe even 10 years, you know.
Sure.
So, and I think if based on what we just discussed and everything, I mean, I think we both agree on that. We don't know, you know, what the scenario,
that we agree on. No one knows.
The scenario is going to be. I think at this point, our most probable scenario is one of a stagflationary up and down, and you know, that exactly that kind of almost magic trick of keeping us in that warm water without boiling us and without throwing us out. That's something that will create a situation where investing in that what we call new era is going to be different. And the concerns or the things you have to think about may be a bit different from, like you just said, what happened over the last 30, 40 years where, you know, back in the 90s, you could have some bonds which gave you a nice fixed income, and then you did some more risk with stock. Those times are far and long gone. And so the question to you, what are the key elements or what are the things you have to consider today in order to invest well? And you touched on it a bit before, but let's go into that a bit more. Yeah,
I mean, so core risk for me is that you remain anchored to a paradigm that is in the past. Yeah, so you just described it. So if you think that you can continue to do those things, I think at the base level that is a risk in itself, because an anchor can moor you in a good way, can also drag you down and drown you, and obviously that's what you're trying to avoid. So I think you need to have a look at what you're doing with your assets and making sure that it's perhaps positioned to some of the changes that are happening, and we can go into some of those. And there's obviously on the flip side of that also some opportunity in that, because change brings both risk but also opportunity. I think there's this old saying which is that when on the horizon, when the storm of change is appearing, you can either seek shelter or you can build windmills. And as an investor, I suggest you probably do both, because you want to have that firm foundation, the shelter, but you also don't want to just miss out on the opportunity of the change that is coming. And I think that's how I would approach it a little bit, is saying there is some things that are constant that we can continue to build around. And I think there's some things where we need to tweak, both at the asset allocation level and also in terms of industries that may benefit from the change versus industries that will not benefit from the change, for example. So maybe on the risk factor, because I think this is an important definition, and I have this a lot when I have conversation with people and clients around, specifically when traveling around the US, is this idea of asset management and risk management. And for me, which I think is the Swiss model, historically at least, has been this merger of wealth management and asset management being one, and you think about them in a collective context, not as two separate aspects. And I find that in our industry specifically, if you go and speak to anyone, and some of the smartest people in the room, they will talk a lot about risk management at the asset allocation level. So they will talk about, all Greek, by the way, to me, how they're managing these dynamic risks in the market volatility. And for me, that's great. But most of our clients are unleveraged and long-term investors. So the volatility is not, there's risk in that, but unless I put the two worst possible things together, which is incompetence and leverage, I'm not going to have permanent lots of capital up at the market level. We don't make concentrated bets in that way. So where my risk is real, where there is the risk of permanent loss, really comes more at the wealth management level. And for me, wealth management is the how to own. But in how to own, you have planning structures. So some of that will deal with legacy and family arrangement around this generational wealth. Some of it is against creditors, specifically in the US, where litigation is a major risk. These are the sources of permanent loss of family wealth.
So you're saying, and I agree, and I think it's a topic for us, is that investing is one part of, protecting and growing your wealth. You have to think about risk management and growth, opportunities and challenge there. But equally important, and for some people maybe even more important, a lot of our clients are entrepreneurs. And especially those in the US are exposed to all kinds of litigation. The structure side, how do you structure things? And structure comes at different levels. There's the legal asset protection, so the trusts, the asset protection trusts, the LLCs and so on. But then there's also just the simple factor of custody. Which institution, which jurisdiction you have your assets, you hold your assets. And I think that's what you're alluding to here. Yeah,
for me, that's the starting point with any new client, for example, is, people like to talk about the investment side and how we're going to make money, but, a little bit less sexy, maybe, more boring is and much more important in my view, at least as a starting point, is how do you own your assets currently? Before we talk about what you currently own and what we might want to own, how do you own? And obviously then that starts with what I would call the mode number one, which is planning structure and litigation for US, specifically entrepreneurial families. This is a huge risk. I think something like 90% of civil lawsuits globally are in the US because of the way the system is structured, how incentives are lined up for people engaging in litigation, obviously. So if you don't factor for this, if you don't deal with this, there's not much point taking risk and working 100-hour weeks to try and build something on top of it if you're ending up with a foundation that is sand. So planning structures, there's far smarter people you can probably bring on here to talk about planning structures than me, but I think the piece I often see missing is the custody piece. So the idea of building elaborate planning structures and then saying, great, now we just need to drop these assets in somewhere, so whatever is cheap and convenient and easy to use, that's going to be my custodian. Often it's not even a thought, it's just, we'll put it into this bank.
Some people immediately will be thinking of FTX right now.
Well, definitely crypto has some really, crypto again always is kind of like the extreme level of it, but there is definitely lessons that can translate, and I think people shouldn't become complacent. It's easy to point fingers and laugh into that space, but I think how many people truly understand their custodial relationship with whoever is holding the majority of their assets right now? Because in many ways, and this maybe comes back to our conversation on Switzerland and maybe on the financial side.
The Swiss rules and the Swiss structure is kind of unique. Even the fact that in Switzerland, us as wealth managers or portfolio managers, we actually don't custody the assets, so we're not allowed to have these omnibus account structures. We always work with banks that are properly licensed that we then have a limited power of attorney for. But then I guess to your point, it's important that bank that you choose has a structure in terms of its balance sheet, but also has a regulatory framework around it which works. And that's where I think the Swiss framework is unique, and not just for traditional assets, also for crypto, by the way. And we can touch on that a bit, but maybe right now, because the biggest part of our clients' wealth is obviously, we do have a few clients that have a lot of Bitcoin and Ether, and but they are the exceptions, I think, still. But around traditional assets, so what's special or unique about custodying with a solid Swiss bank versus, let's say, a bank in the US?
Yeah, so it's actually two business models are completely different. So again, if you go back history-wise and look at what traditional banking was, or what banking used to be, it was a custodial relationship. So you would bring gold, or you would bring some asset. We moved into securities. We have cash accounts, but it used to be that this organization was built to basically maintain and look after these assets, and you would pay a custody fee for this service. Yeah. And that's a pretty boring but pretty steady model, And somehow we drifted away from that over time. And those are all on a kind of a gradient again. So there's, the outrageous stuff that we're seeing in crypto right now, where there's absolutely no title-held assets, no real checks and balances, no business model that you would want to trust, And then into something that feels more comfortable and more day-to-day. But even if you dig into some of those relationships, you will probably find that in most cases, certainly for the cash component, and then into the asset component, it varies a little bit about what kind of activities you're doing. But most times you will have a sub-account within a financial corporation that is risk-taking in nature. And when times are good, it doesn't really matter that much. It's convenient. You have you can log on and see your assets and your balance, etc. And it all feels nice and comfortable. And that's maybe fine
But you're talking about the U.S. model now?
I'm talking about most things that are
general?
non-Swiss banking, because back to your point, there is a specific rule where we
we
retain that core of the custodial relationship.
Custody, and you pay custody fees, and your assets are segregated from the balance sheet of...
Exactly. For me, this is the core. When I speak about Swiss banking with anyone, the first conversation is I want people to understand that piece, that Swiss banking maintain that core relationship of being a custodian, and that the contractual agreement is around a title-held ownership of an asset that they are custodying for a fee, and that is their business model. Yeah. And it's also important to say here that there are Swiss banks who veered away from this, and some of them have been in the news of late, tried to become investment banks and do risk-taking activities. The banks we tend to work with are pure custodial banks, maybe with a little bit of asset management, but with no real risk on their balance sheet.
It's really important, and I think I just want to be very clear for viewers, the way we look at safety when it comes to custody. We look at it first at a jurisdictional level, then we look at it at a institutional level, so which bank. And there, it's very important that for me, Credit Suisse, UBS, we do not work with them. Why do we not?
I'll let you mention it because you're Swiss.
I'll mention it openly, and I'm not saying those are bad actors or anything. No,
sure.
They're important players and pillars of the Swiss economy. However, as an investor, I prefer banks that are not exposed to the obligations of creditors, that are not heavily invested in all kinds of investment banking type activities. And ultimately also that, are not in the business of creating all kinds of very aggressive strategies, investing themselves. And Credit Suisse obviously has been in the news lately, and, obviously something's wrong with their risk management. And so that's that, because institutional level. We prefer institutions, we work with private banks that are not in that kind of investment banking, commercial banking. Most of them don't even have mortgage banking. So it's a completely different business model. And the third layer, which I think is important, is the contractual one. Yeah. And so getting that all right is what you're alluding to right now.
Exactly. If you're again, having built generational wealth, you have options in life. Yeah. And you got to make decisions. And again, if you have options and you're making decisions about the kind of planning structures you want, working with very priced lawyers, doing all of this work, it makes sense that your custodial piece should also match that. And for a lot of people, it's different pieces for different activities. So you may have different assets. We talk about crypto. Maybe people are trading. Maybe you need something that is more functional and fast moving. And maybe it's not so important to have, true contractual ownership of every single asset within that context. But maybe that's the tip of the iceberg, and then you have your larger holdings, and within those you want to have safety. Yeah? That's your objective number one. Absolutely. When I work with a client, my job is to protect the wealth that has been created through hard work, a little bit of luck here and there, and some smart risk taking. And that is my main job. So at the risk management level for me starts at, have they figured out the planning structures right? If not, let's refer to some of our good friends who we've seen for decades do good work for families. Secondly, what custodians are they using, and how can we use the type of banks you just described, and where ideally they're owned by the same families for hundreds of years, where there's an alignment because they're still private companies to not take crazy risk and not try and mirror, let's say, the Credit Suisse model. then we are in a good place, because then we can start moving large chunks of long-term assets into those types of custodians. And sure, if the client has risk-taking activities that requires a different type of custodian, that we can also build entities and custody around that specific activity, but it should not be confused with the larger long-term wealth.
The first step is that element of safety, and I think, if we look at BFI's history, and you look at the services and the advice we give, which is around cross-border type investing and planning, safety has always been the top priority. A lot of people, I think, when they hear cross-border, they immediately think of tax, efficiency, or they think of global investing, which is important as well. But actually, the top priority, I think, in my view, is really safety. Just getting things into a safe custodial context, and also protecting it from things like frivolous lawsuits and so on. That's really the top priority.
Yeah, I think people ask why Switzerland and why Swiss bank, and I think we just addressed why a Swiss bank. It's simply because it's not because it is Swiss by the nature of it. It is the model that they operate, and the fact that you can still have that type of bank here, which I've looked around the world, because I'm not Swiss, and I've looked at different options, and clients sometimes ask me, can we find other options, other things? Is there not a cheaper way to do these things? And I've looked and I haven't found.
Let's break that down real quick a little bit more. So when it comes to traditional assets, let's say stocks.
Sure.
If I understand you correctly, and I wasn't aware of it to that level, is that I know the Swiss rules. In Switzerland, it's very clear that if you own stocks in your custodial account with the bank, those stocks are not part of the balance sheet of the bank. Those are your assets. You own them, and in the case of an insolvency of the bank, you will continue to own them and get them back. Are you saying that's different in the US in terms of the rules?
What I would say is that there is a gradient of it. So it's very important for each person not to be alarmist and jump out and move. Certainly you can call us up and move everything tomorrow. That's welcome. But I would not suggest that. I would suggest you actually sit down and ask yourself, who is my custodian of the largest parts of my asset portfolio?
Right.
And what kind of contractual agreement, not an accounting-based agreement in the sense that I open up my laptop and I see.
So you're saying this issue or this potential risk is not necessarily at the regulatory level, it's at the contractual level. So depending on the contract you have with your advisor, which may have an omnibus account, or your bank, you may actually be exposed to the fact if something happens to them, you will not have your assets anymore.
My key message is understand what custodial relationship you do have for your largest part of your assets. It's not fun, but they send out a lot of pages with a lot of very small writing on them. There's somewhat of a reason for that. Now, what I would be looking for essentially is there's a convenience aspect. So like the idea that we can get on our smartphone now and trade, thousands of different stocks and all kinds of options and whatever you want. For that all to really work, no one really asked that inconvenient question. Is it settled every day? Is it held for my account? Is it held with, whatever bank I'm working with at some kind of level? The answers to that is probably gray zone, and you want to understand it, at least what it means, and see if you're comfortable with it, because we should be planning for worst case scenarios when we're dealing with that level of wealth over a longer time period. So it makes sense that at least the majority of this wealth should be housed in a place where there is no gray, there's only black and white. I own, it is title held to me or the entity that I've set up for it. And I think the other side of it is, the other thing we often get when you have a new client is custody fees. Why am I paying custody fees, And, I've been around the world a little bit, and you're going to get what you pay for. And if you're not paying for custody fees, I'm not sure you're getting custody, because these are, for-profit organizations that you tend to work with in this space. So either they're giving it to you for free because they're making money off you in some other way. So either they're trading on the back of you, or they're leveraging the fact that they have a big balance sheet, which then, if they're doing that in some way or format, you're part of that balance sheet, is in some way they have an ability to leverage that. That would make me feel uncomfortable at a starting point.
Absolutely.
So
what you're saying is the devil is in the detail, and you should go and check those details out, especially when it comes to structure, because I agree, the structure side is where you could lose everything.
That's permanent loss. I mean, as people are finding out who had their crypto on FTX right now, and that's really sad, but the reality is that people went for something that was too good to be true. They felt they could get leverage and trade all of these things, very light KYC, no custody fees, often would pay you to keep things on in yield products, etc.
Let's touch as soon as, sorry to interrupt you, but with regard to crypto, just to because it's the same topic, and you just mentioned FTX, and you know, we have quite a few clients now that actually did very well in the crypto area, and they're now starting to bring assets to Switzerland as well. And it's interesting there too, the same kind of logic applies. And there's something we sometimes refer to it as hybrid banking, right? Where the bank that our clients then deposit their cryptocurrencies, their digital assets in, is a bank which actually then comes with that same kind of regulatory framework, where the bank then takes care of the private keys, takes care of the risk to some degree, because your assets are not exposed to the insolvency of the bank and so on. So maybe describe that hybrid banking approach a bit. That might be new and
I think it's
interesting.
I think that is interesting, obviously specific to people with crypto. But again, for me, it's just another asset in the context of what we do. So protected. So again, my journey and the solve that we had in crypto initially was people who had bought crypto early. So not so much about the market volatility. Again, it's really more about they build generational wealth, but mainly in crypto. And then the same challenges arise. So planning, how do I get this into a planning structure, was actually how I started trying to solve for it. Was someone who had what started as a smaller position in crypto with price accumulation became a significant part, yet they couldn't figure out with their local advisors how to bring it into planning structure. So they already had, you know, asset protection and all of this set up for traditional assets. But every time they start knocking on the door and asking about crypto, this was 2016, 2017, I think, so earlier, there was no real solutions for them. So we started with a solve. So again, back to your point about being a Swiss asset manager, we are fiduciaries, meaning we sit on the same side of the table trying to solve for issues, objectives and challenges of the client. And here was a clear objective and a clear risk for the client. So I started speaking with some of the trust companies because we wanted to try and get into a trust about what would they need to be able to accept this crypto. And they were not interested in cold storage or them having the keys, because then they have liability risk, obviously, and they didn't fully understand how it worked, and they would have to figure all that out. But they basically said to me, Sune, if you can find a true custodian who is regulated, who meets what we would feel like with any of the other stuff we do with you, then sure, we would entertain this. And then that became the journey. And obviously, again, the realization was that because the regulatory framework here in Switzerland and in Liechtenstein at much earlier stage leaned into the crypto space and said, look, we see innovation, but we also understand finance and business, and we also understand that there is, with any new innovation, you know, the risk to an investor, the risk to someone who doesn't truly understand what they're getting involved with. And so we want to have some checks and balances on you, but we'll also let you build out and explore. And that has led us to a place where we now have, you know, truly regulated digital asset banks here, where you can do many of those activities that people want to do on all these very risky exchanges, but within a regulated, title-held environment of these assets. And, you know, we put those two things together, and you ended up with the ability to custody within a planning structure in a regulated bank.
With both traditional and crypto assets.
So then you can mix it, obviously, and you know, I think there's also...
So you get one financial statement, basically, with both digital assets, cryptocurrencies, and other stocks and bonds and so on.
Absolutely. You can do that within one bank, and obviously a lot of our clients tend to a multitude of accounts, and I think part of our value proposition as an asset manager is that we do consolidated reporting of some of this stuff. So there's obviously the ability to move between them, but again, it's the core idea that we're unconstrained investment managers globally, meaning we invest in traditional assets across, you know, physical gold, securities, all types of, you know, alternatives now more and more.
Right.
Crypto should be a piece of that. It shouldn't be separate to that. And when you're building an investment strategy, if you are someone who have a lot of your wealth in it, you may want to diversify out of it. That shouldn't be so cumbersome as it would be without this type of solution. And I think maybe a last point on crypto, which I think is at the core of the innovation. So there's this thing, my keys, my crypto, I'm my own bank. Which is obviously part of the innovation to some degree, is this distributed without the gatekeepers type system, which is, I think both of you and me like the idea of, but there is obviously a reason why we have banks. And I think being your own bank is great if you got 50K, but if you got 50 million, do you sleep well at night? You know, do you have those things? Where's my key? Where's my things? Am I putting myself at risk if it's known that I have all this wealth at home, just like if you had traditional wealth of that level at your house that you had control of? So there's some very basic things, and then there's the whole thing about how does planning work, for example. So if you wanted to protect yourself from litigation, you need a trust structure. So you're separating yourself for the assets. So by definition, you cannot also have the keys, because then you are in control of the assets.
Right.
So when I work with a lot of our planners, for example, who are starting to see more and more of this type of crypto interest, or people who come in and say, I have significant crypto, the first thing to overcome is this idea that you have to separate yourself from the keys, and then it becomes a conversation about what are the least bad options. Yeah, because who do you really trust if you're handing it over? Do you trust the trustee to have your actual wealth? Do you trust who as a custodian, maybe a friend?
Right.
None of this is really great solutions. And if you look down that line, if you come from that space where you're thinking my keys, my crypto, I want control, probably the best possible solution is still to have title held assets in a regulated, so therefore predictable space within an organization that is built around providing custody. And then we're ending up back in the same place. It's just a digital asset bank as opposed to a traditional bank.
Right.
And that is why for a lot of our clients in that space, it is about taking control and putting it into planning structure still, but also having that custody piece specifically in that area is key, because unfortunately in the US right now, you can't really tick the regulatory box. So a lot of these are operating not by decision, excuse me, but they are working outside the regulatory framework. That leads to the FTX type scenario, but it also just leads to good people trying to build businesses, but having regulatory risk because they don't really have a clear playbook like we have here.
Yeah, to some degree with when it comes to cryptocurrencies and blockchain technology, some of the original ideas were obviously very freedom, self-responsibility oriented, which we're fans of. But at the same time, there's also something to say for having good regulations and some safety and measures. And so I think that balance of becoming also a bit more institutional is still underway. And what you can say with regard to regulations, and I think it will be very important to see what happens, especially also on the cryptocurrency front, is that Switzerland has gone ahead with very smart regulations. The US at this point is still lagging a bit behind, and I think a big part of the world is actually waiting for regulations coming out of, for example, the SEC,
Sure.
And to provide more clarity. And I think once they do that, depending on how that regulation turns out, I think cryptocurrencies will see a more of an upturn again. I think a lot will depend on that. Currently, you don't see, for example, a lot of the sovereign funds and so on. There's some big players. Obviously, we heard about BlackRock, sure, but some of the sovereign funds and so on haven't really invested in the digital sphere yet. One thing that I also think is important, and I'm definitely going to have some fireside conversations in the near future on that topic, is that with crypto right now, one question is crypto dead? And, I kind of cringe when I hear that, because I think to some degree most cryptocurrencies are useless. There's no real use case, but the blockchain technology per se and cryptocurrency and the payment use cases and so on, there's a lot of use cases and a lot of potential for blockchain far beyond cryptocurrency. And I think in that regard, I think people should stay open-minded. And I think right now the whole area of digital assets is an area which you should continue to consider investing in, but at small chunks. If I look at our portfolios, obviously cryptocurrency is a very small thing. We love to talk about it because I see the opportunity and I'm fascinated. We're also invested in, with Exedras, we're invested in that sphere. But at the same time, we also have to caution people. We're not suddenly now only into digital assets, or we're not a digital asset investment manager. No. We're focused more on the things that you touched on, and those really start with safety, with wealth protection at both the structural and the investment level. Yeah,
it's a great point. I mean, so for me, the thing, number one, I don't like the word cryptocurrencies because I don't actually think any of them are currencies. You could argue the stable coins might be acting a bit like a currency, right, or at least an intermediary of it. So for me, it's kind of an innovation, and I think for me, when people say, what is investing in crypto, which is a question I get quite a lot, and for me, there's Bitcoin. It has a unique use case, which in some ways mirrors what gold has been to people. I think that is real. It has a real network effect around it. It has 10 years plus of looking at data. So as an investment manager, as a risk manager, and as an asset manager, I can get my head around some of the concepts within why that is something I would want to have in my portfolio. To be fair, everything else for me is venture capital-like investment. So if you think about it just purely, take away the word crypto and just look at the profile of it, how you would classify it within an asset allocation plan. Often illiquid, often very much at the idea stage, often a small group of people around it, not a lot of network effect. If you look at any of the data, it's kind of a hockey stick. Well, dipping down a little bit recently, but literally you have maybe like, let's say 18 months, of data, number one, and like the first 10 months of that is more or less flat, and then you got this pickup, and then you got some volatility when you focus in on the more current. Right. So when I look at that, for me, that is venture capital in nature. It's illiquid often. It's very early idea stage. It doesn't mean I don't want to invest in it. It just means I need to understand the risk of being in a liquid space that is very early and where it's very hard to get any grasp of what is the potential solve that this business, this token, whatever you want to talk about it as, essentially meets, and then you can project something into the future. So to your point, it's a speculative asset. I think depending on your profile, you want to think about it like that, and there is definitely a room within the portfolio for it. But again, I would kind of see it as in the context of a larger allocation, not as something unique to the side that again, people say, can you make me an active strategy in crypto? I'm like, we can buy Bitcoin on the dip and accumulate it if you believe in the core concept. If I like that a lot. If you think about Ethereum, you can probably figure out that is maybe an interesting space for some innovation, but maybe all of the other stuff fits within more of your venture capital portfolio. And then it should maybe be a mix of different ideas within technology that you want to be in. Because again, for me, one of the core themes of how you generate wealth over time is you try and harness innovation that unlocks key economic industries at the time of a paradigm shift. And if you look at the last 2.5 decades, you can go through the semiconductors from the late 90s into the internet. And then the internet very early on, it was a rough ride in many ways, both in terms of being an investor, but also just in terms of what it's actually going to be able to do on this thing when you're kind of dialing up on copper lines and you can't download anything, to where we then get to the smartphone, and then we get to this digital economy, and the other side of that. So those are like, in the last 2.5 decades, the majority of all wealth that has been created in the world outside of, let's say, real assets like real estate, etc., that has appreciated, has come pretty much on the back of that semiconductor seed corn that then spawned into this wonderful tree and all the stuff that came out of it on the back end of it. So if you were investing back in let's say mid-90s, and you aligned yourself with those lifts across it, you would have done incredibly well. If you look at most of the wealthiest people today and where their wealth was created, it was by being entrepreneurs and innovators across that long journey up. And I think the interesting part for us going forward is, you asked me about the next decade ahead, we talked about some of the risk. I think the opportunity is to kind of harness the next lift where you're seeing technology overcome bottlenecks, overcoming some of the challenges that has maybe kind of put a ceiling on developments within parts of our economy that are significant.
Yeah, on the digital assets, how to invest in crypto, I think we actually put quite a bit of thought into that. And we recently just launched Alpha Digital, which is basically a fund of funds, because it's I'm very much reminded currently in the sphere of crypto to the time back when we started with hedge funds. Yeah. When there were new ways for funds to invest, and some very good and focused hedge fund managers came out, and the way to then take part in that sphere, again, for me, is not investing in one hedge fund, but actually creating a portfolio of multiple hedge funds. And that's something we created over time, which we used to call Abacorum, which has been an extremely successful investment strategy. In that, even this year, we're up like 8% with a volatility of about 5%. So that's one sphere. And now I see kind of the same thing evolving, where it used to be you had to deal with the limitations of hedge funds, the low liquidity, the high thresholds to get in, etc. And the same kind of thing now happens in the sphere of digital currencies, where you have to find ways to, first of all, even find the good strategies and managers, find those nuggets of funds and fund managers, and then diversify among them. And but that's for another conversation. I think one thing we've talked about recently was chips, but I think we're kind of running out of time here. We also, one topic I'd love to talk with you about, Sune, maybe in another fireside conversation, is the whole topic. We didn't touch on that today, but I think it's one of the, talking about risks and opportunities, it's one of the risks is energy. The energy crisis going on in Germany and Europe, other parts as well. But the question of how do we resolve, this dilemma of trying to, wean ourselves from fossil fuels, which have been a huge blessing, but also to some degree in some areas a problem, and really transition into different kinds of forms of energy. And so that would be another long conversation.
We could definitely do it. We could do a very quick one, and we could do a long one.
No,
but
I think we can't do this today anymore. But let's maybe plan for another one.
For sure.
And, so I think we're running out of time. Maybe just, irrespective of investment, in your view, I always like to ask this question, and I'll make that kind of a tradition, as to what's, in your view, looking forward, also thinking of your kids, what do you think are the biggest challenges, and what are the biggest opportunities over the coming years?
That's a big one. Thank you. I think the challenges is this, what we talked about, is the transition period. I think this decade is a transition period across societies, across the economy, across technologies, and you mentioned some of the key technologies I think we need to figure out. And I think that within that there's challenges in that, and that it's not going to be a straight line up to the right, and that brings them. So on the flip side of that, though, is the opportunities. I think we to our point about the US going through the 70-year cycle. In fact, many of our core technologies, besides, let's say, the semiconductor, which is more of a 20-year thing, but you talked about energy. A lot of our systems that have served us very well are kind of coming to the end phase. It's definitely not the beginning anymore of them, and we need to find new solutions. And if you look at the size of some of these industries, whether it's around manufacturing, we can talk about automation, of is an area we invested in a lot, for example. The digitalization of society, we touched a little bit on today. And then you can go into things like energy and transportation, which are literally $1 trillion annual industries that mainly have been built around technologies and systems that were from yesteryear. And then you can look at all the physical infrastructure attached to them. Within all of this renewal and within the solutions that we're eventually going to find out, because we started with Switzerland and working against constraints. So I would probably say that I see the constraints and the challenges, but I actually think that's probably what's going to give us the lift to move beyond what is today. And within that, there's going to be huge career opportunities for children of ours. And there's going to be investment opportunities, maybe more shorter term and longer term for us and our clients. There's going to be great opportunities to be an entrepreneur in those times, because this is literally the kind of periods where there is creative destruction of some of the past, and some of that needs to go, whether, we can talk about within the financial aspect or within the broader economy. But obviously on the other side of that, there's also kind of a new beginning of many things, and I think that's super interesting. So I tend to like to think about that both as an investor and as a parent, while I'm obviously starting with the Swiss way, which is risk first. And some of the challenges, I've certainly got my eye on those as well. So, you got to do both. You got to have both the windmills and the shelter.
Well, let's build some windmills then.
I'm Danish, so I'm leaning in that direction, as you know, but I'm not necessarily pitching no one go and buy just the windmills. It's more the symbolism of it.
Got it. Hey, thank you so much, Sune.
Thank you.
We'll have another one of these for sure. And
the frank conversations, I think, is you can take that as branding if you wish.
There you go. Hey, thank you very much.
Pleasure.
And I hope you make it well through that snowstorm.
Yeah, but we're in the shelter now, so we could be outside completely covered in snow. It could all be gone.